Now, getting into portfolio construction. So, what are we talking about when we say portfolio construction? Well, we wanted to look into things like portfolio size, meaning how many assets you should include in your portfolio. We wanted to get into researching indexes for optimization, indexes like the S&P 500 or the Dow Jones Industrial Average, essentially to understand if changing any of that made a difference. And then we got into things like the optimization rate and tried to figure out how frequently you should rebalance your portfolio. And in our initial testing, we talked about how we optimize the portfolios quarterly or 4 times a year. So for this next step, we created a new method that was set up to test how often you should actually rebalance your portfolio. Now, there are some academic methods that talk about this, and that was kind of the original inspiration for some of these questions. So we'll show you what we did, and in my opinion, the results make sense. The first thing we got into was portfolio size, or the number of assets that you should include in your portfolio. We tested quantities of 5, 8, 12, 20, and 30. And we did that so we could see a variety of different sizes to see if that made a difference. When choosing the number of stocks for your portfolio, you should also consider the amount of time that you want to spend on your research. So if you think about it, a portfolio with 30 stocks really has a large workload that comes with it, and you might only have time for a portfolio with 5 stocks, and that's okay. When you only have a few, you might think that that's actually more risky, but as you can see here, depending on your strategy, and we'll get into this, that might actually be preferred. So what we found was that on average, the best performing portfolios tended to be in the middle, and for certain metrics, it did say some quantities perform better than others, but on average, it showed that the portfolios with 12 assets perform the best. Now that said, when you look at each of the individual metrics, you find that certain quantities of assets tend to work a little better than others. And earlier I mentioned that I like using Sharpe's measure. For me to get the best possible return, I should go with a portfolio of 8 assets. Now I could also go with 12 assets or even 30 if I feel like it. Those portfolios outperform the market, but why would I want to keep up with more if I can get a better return with just 8 or maybe 12, which that range, that's also what academia taught me was ideal. It seems like for most metrics, you should include anywhere from about 8 to 12 stocks in your portfolio. But if you want, you can include up to even 15 or 20. Anything beyond that, really, unless you're a fund manager where like it's your job to keep up with them and all you're really likely doing is giving yourself a whole lot of hassle for not much more return. And, the point of all this training is really to learn how to work smarter with all of this and not harder. An old manager of mine used to tell me that effort does not equal results. And he's right. You have to know what kind of effort gets you the results that you want. And in this case, all we're saying is not to overindulge with investing, which most investors will agree is easy to do. Plus, once you're in that neighborhood of 30 stocks, you might as well buy an index fund. And this training is more aimed at helping you understand how to build and manage stock portfolios rather than, purchase index funds. In terms of testing the index, there were 3 measures that we leverage in testing where that could make a difference. It's alpha, trainer's measure, and then the overall average. So those are the metrics that we tested here. We changed the index between the Dow Jones Industrial Average, the S&P 500, the NASDAQ Composite, and the New York Stock Exchange Composite to see what differences that would make. Taking a look at the results, there's really not a noticeable difference between them. The best performing in terms of the highest average were the New York Stock Exchange Composite and the S&P 500. The median was the Dow Jones Industrial Average, and each of them for at least one of the time periods did rank as the number 1 index. So we leave the default in our reporting as the S&P 500. That's the red line on this chart, which gives you a pretty good return and really the optimal return for several time periods. If you want to see stock metrics based on different indexes, you'll probably have a hard time finding anything like that. In the end, there's really not much of an advantage. So, kind of what's the point? Our computer system can do it, but right now it's not included in any of our reporting. Probably the topic you're most interested in and will remember after this lesson is portfolio optimization. So what do we mean by portfolio optimization? Well, the term optimization refers to finding the set of asset weights that produce the optimal return, which is the portfolio combination that was tested with the highest return for the lowest amount of risk. And we'll walk you through all of that in more detail in Portfolios 200, but for now, we're just providing an introduction to this topic. Now, as you can see here, we went back and revisited our portfolio construction method to come up with a new way that took beta into consideration. And in these returns, you don't see quite the dramatic swings that you saw with the other studies, but nevertheless, it does paint a clear picture of which ones outperform the S&P 500. We wanted to test daily optimizations as well, but we didn't have the intraday data for that. That might be something we look into in the future, but in general, we tend to discourage folks from day trading unless you have some really powerful tools that are going to help you, keep up with the market. We'll get more into that in Portfolios 400 when we discuss strategy. We actually call it popularity-based trading, where essentially what people are trying to do is trade off of the peaks and valleys of the events of that day. And in general, we discourage from that because what you're trying to do is time the market, which can be a bit of a fool's errand. And in this training, when we use that term market timing, we mean something different. Now, it's true that when you have a few $1,000s, you can flip it a few times and make 300, 400%. The problem most people run into in that situation is when they do have more money, they try to do the same thing, and the volatility becomes something that catches up with them. So trading without really knowing what you're doing, it can still feel great, and then all of a sudden, if you do it right, you might end up with a pile of money. And then some people become terrified at that point, and then they don't do anything with it. So when you end up with a larger amount of money to invest, you still want to be able to have fun and take risks, but you want to diversify your risk, and this becomes way more important. And that's where portfolio optimization comes in and become a helpful way to reassure you that you're making the right decisions. Now, what a lot of people want to do is look at their stocks all of the time, but what really stands out to us was that even if you're looking at your portfolio every week, meaning maybe you're making trades on a weekly basis, the reality is you're probably not holding on to your assets long enough to create any value for your portfolio. And, if a week isn't long enough, are day traders really generating value? And what we found was that from about 2 weeks out to about 8 weeks, that's where most of the value creation is in your portfolio. And if you hold on to your assets a little bit longer, certainly it's understood if you have some dividend paying stocks where you don't feel like you have a need to check them as frequently, but ultimately you want to revisit your optimal portfolio and rebalance at least twice a year. So if you're checking it weekly because you're thinking you're going to get some hot tip or some lottery win type idea, what you're really doing is you're extending yourself and you're putting in energy way beyond what's required. And you probably, have much better things to focus on. So in reality, you only need to check your optimal portfolio and potentially rebalance about every 2 to 8 weeks. Or an easier way to think about this is maybe once a month. So if you think about rebalancing your portfolio about 12 times a year, that's not so cumbersome. And doing the research to do that doesn't take a whole lot of time. Come on, some of you, myself included, probably spend more time setting your fantasy lineups or looking at sports news or the latest celebrity gossip. So don't be afraid to spend some time doing research for your portfolio. Now, a moment ago, I mentioned market timing, and I said that that's not necessarily how we view it in this program. Market timing is generally used when referring to people that are trying to time the market, meaning to buy when stocks are at their lows and to sell when they're at their highs. And the problem is that's very hard to do, and there's generally, a lot of stress associated with trying to get it right. Plus, when all of it is said and done, you miss out on those moments of unexpected returns when the market does the opposite of what you thought it was going to do. So maybe, you went out and you shorted the market, or you sold your stocks because you thought that you were trying to time the market properly, only to find out that the market took off and missed out on further returns. This sometimes happens more frequently than we would like. And what we're trying to get you to understand about market timing is not about when to jump in, but rather which strategy to use based on the current market conditions. So some of these metrics, depending on what's going on during that year, will perform better than others. So when you see a growth year, there are some metrics that might perform a little better. Like if the economy is really booming, expected return picks are generally going to work out pretty well. But again, if you're looking at a lot of these years here in the 2010s and you're trying to find a particular metric that works consistently over time, I would take you back to my favorite metric, the Sharpe measure. That one, it doesn't always have the best return, but it typically performs well, and it also limits losses in down years. So overall, you can see that each metric has years when they perform very well and at their best, and then some metrics do tend to fit certain market outcomes better than others. Now, we can't predict what the market is going to do, but we can show you what has worked and what is working, and that will give you an idea of how to plan and how to look when selecting stocks for your portfolio. Now, in our training program, we're not going to offer any predictions for how we think the market is going to perform, because that's very difficult to do. And, there are a lot of great professionals out there that you can talk to, as well as even others online, where you can listen to their podcasts or subscribe to their channels. People who monitor those sorts of things more closely and can give you a better understanding of how they feel the market is going to perform and what to expect. And those individuals are doing a lot of analysis and research in order to make a lot of those predictions. We're just here to coach you on how to manage your portfolio while showing you what's working. That way you're better prepared when determining your strategy and making your picks. So in terms of the results of our studies, we have a technical research overview on our site where we go through all of the research and testing that we did in more depth. Our intention with that is to update it at least once a year, so that way you can see what's working. Now that said, when you combine everything that we've tested, what do the results say? Well, depending on the type of year that you think we'll have, whether you're predicting a flat market, a growth year, or you think it could be more volatile, there are different metrics that tend to work better in those situations that you can take advantage of. And even more so than that, you have to consider the return time periods that you're using and even how many assets you're including in your portfolio. All of those things should be considerations based on the strategy that you pick. Now, ultimately, what we're trying to do here is not necessarily define a strategy for you, but educate you so that you can understand that there are different strategies out there and how our testing shows to use them for the best outcome. Now from there, you can go out and you can pick the assets that you want and then build and manage the investment portfolio that you've always wanted. So just to try and summarize what we're coaching here, at this point, hopefully you've started to get the gist of it, but so it's a little bit more clear, I wanted to lay out the idea a little better. You start with trying to figure out what metric or strategy you think will work best for the current market conditions. Then you use the grades to search through and compare assets. Once you have the assets that you want, you optimize your portfolio and apply risk aversion so your risk is balanced. And then from there, it's all about checking the optimizer about every 2 weeks and deciding if you want to change anything. Now, whenever you do go to make changes, whether that's buying more or selling off some of what you have, or maybe you just want to rebalance to a new optimal portfolio using the same stocks. Whatever that motivation, you always want to weigh your decisions with any potential tax implications. And that's one of the main reasons why it's always a good idea to consult with a financial professional before making any changes to your portfolio. Now keep in mind that while this program is here to help educate you on how to manage your portfolio, we'd always encourage you to work with financial professionals and have a touch point with them before making any changes. That will help you avoid any unforeseen pitfalls and give you a different perspective to consider before making any changes.